Well, hello out there. This is Hal Otey with Hal Otey Financial. And it's been a while since we've done a video like this, but I want to take a few minutes just to address something that we sense is going on out there and what we would refer to as the fear of missing out. And so, as clients of our firm, and for many of you, friends, people that we love and care about, I want to reaffirm our mission to you all, which is that we are committed to enhancing the quality of your lives in the areas that really give your life meaning and purpose. And when I say that, I'm not talking about just financially, but I'm talking about your overall well-being, your physical well-being, your mental and emotional well-being, your spiritual well-being. And let's face it, life is more than just about money, but obviously money is the reason why we're talking today. And so I know there's a lot of speculation going on with what's going on with the market, and there's this sense of, hey, the market keeps going higher, we're not participating, what's going on, what are you doing? So again, I just want to reiterate to you that we do have your best interest at heart. And I want to try to educate or explain a little bit about why we're positioned more conservatively right now, how we plan to navigate the next 6 to 12 months, and why we truly believe this will be in your best interest. And you'll see that plan out sometime over the next 6 to 12 months. So over the past 30 plus years of working with people like yourselves, retirees, pre-retirees, people that have accumulated a decent amount of wealth, there's two main concerns that we hear from you all. Number one is you do not want to run out of money in retirement, right? You don't want to run out of money before you run out of life. Number two is you really don't want to participate in another large market drop. Now, with the market continuing to go up like it is, I think people's memory gets a little bit short, and we forget how awful that 2000 to 2002 tech bubble was. When that burst, the market was down almost 50%. The tech stocks, on the other hand, were down almost 65%. The subprime crisis that happened in '08 and '09, that's a little more fresh on people's minds, but it's still, over like 15 years in the rearview mirror, right? But when that one went down, the market lost over 57% of its value. So what we're talking about today is some of the warning signs we're seeing and some of the things that give us cause for concern. So the first one of those is what we call leading economic indicators. Now, leading economic indicators basically are about 10 different indicators that they look at that give a sign of the health of the economy. When those are negative for more than 4 or 5 months, typically a recession follows, and that's data that goes back to 1960. So up through January of this year, those leading economic indicators have been negative for 22 months. Well, they went positive slightly in February, but then again, they've been negative March, April, May, and June. That's a cause for concern. The second one is what we call an inverted yield curve, and that is when short-term interest rates are higher than long-term interest rates. We've now had that going on since July of 2022. If you go to the bank, you're going to get a 6-month to 1-year CD that might pay you close to 5%. If you want to lock that money up for 5 years or 10 years, you might only get 4 or 4.25. So short-term rates are higher than long-term rates. Typically, when that happens, when we have this inverted yield curve, that points toward recession. The third thing that we're looking at is the top 10 companies and the percentage of our overall economy and GDP that those represent. Now, if I go back to the tech bubble in 2000, when that got built up, the top 10 companies, those top 10 companies represented about 30% of the economic GDP of our overall stock market. 2022, the top 10 companies, again, represent closer to 55% of the overall economic value of our economy right now. So if something happens and that bubble begins to burst, that could be pretty ugly down the road. So we're just letting you know that there's some warning signs. Another one is commercial real estate. So, in the past, if any one of these warning signs was going on, it signaled potential recession. Now we've got 4 or 5 of these flashing at the same time. And, so in terms of having your best interest at heart, it's fun to ride these things on the way up, but I can promise you, you don't want to ride it on the way down. So here's kind of the bottom line to this. The worst thing that can happen if we're wrong, which we don't think we are, but if we are wrong, we've been wrong for the last year or so, but if we're wrong, the likelihood is the Fed is still going to lower interest rates. And when that happens, the bonds we're in should up in value. You remember that in 2022 when interest rates went up, the bonds went down in value. Well, now the opposite is going to occur. If interest rates go down, bonds go up. Now, if we're right and we do go into recession, the same thing is likely that the Fed is going to cut interest rates, and probably even more aggressively if we go into recession, which means the bonds will go up in value even more. And then if we avoid a big, sell-off in the market, that gives us an opportunity later to be able to buy back in at much lower values. So we believe that patience is going to be rewarded in the long run. But just to put a kind of a button on this is just to say, look, here's what we're looking at. Here's why we're concerned. Here's why we're keeping you more conservative. But if you still have questions about this, or if you're still frustrated with this, let's have a call. Let's schedule a 20, 30-minute call. If you've not been in for a review, let's get that scheduled for you. But again, just understand that we do have your best interest at heart. We do believe this will play out for you, and I hope this has been helpful. Again, if you have questions, give us a call. This is Hal Otey from Hal Otey Financial signing off, and we wish you the very best. God bless.